Okay, hello everyone. Now in today's session, we are going to discuss a small issue of working capital management theory. Remember, in working capital management topic, we have discussed receivable management. Okay, in working capital management, we have discussed a topic, receivable management, but the receivable management we discussed in working capital management was related to domestic receivable. Who is a domestic receivable? I sold goods on credit to a customer in my country. The customer is also in my country. So I have to receive money from the customer who is in my country. He's a domestic receiver. Okay. But there is a small area of theory, no calculation. If you are selling goods outside and your receivable is a foreign account receivable, how will you manage that? Okay. Now, one thing that should be paid attention to, that foreign accounts receivable present some additional challenges to a business that are not present with domestic customers. How? It is harder for a business to pursue any overdue payments from business in another country with a different legal system, right? Let's suppose I am in United States and I have sold goods to a customer in United States. Both are under the same legal system. I have to receive money from him. Okay, he's in the same country, I'm in the same country, domestic receivable, risk is less. But if I'm selling someone outside US, he becomes my foreign receivable, the risk is high because now the customer belongs to a different country, different legal system. Okay. One option for a business is to simply trust the foreign customer. One option is to simply trust the foreign customer. Okay. This method is called open account. Okay. But this option means that business faces a level of non-payment risk, right? If I trust the customer, send him goods, this is called open account. This means I will always be facing a non-payment risk because I have sent the goods just on trust. If he doesn't pay, I always have a non-payment risk. Okay. So how to manage a foreign account receivable? There are a few techniques. First technique is called advance payment. Now, what is advance payment? Advance payment means before sending goods, you ask an advance from him. Obviously, when you are asking advance, the risk of bad debt is minimized. This is a way to manage foreign receivable. But people resist this, that if I pay advance and you don't send goods, what will I do? However, this is a separate issue. But to manage foreign account receivable, you can do one thing, ask for advance payment. Okay. Second issue is called forfeiting. Forfeiting is also called invoice discounting. Invoice discounting is where the forfeiter purchases receivables from seller at a discount. Let's suppose I have made foreign sales of $100,000, right? Foreign sales of $100,000. I have to receive foreign receivables, $100,000. What is forfeiting? I sell these receivables to some company, which is called forfeiting. And they purchase these receivables from me at a discount. Like, let's suppose receivables are 100,000. They purchase all these receivables from me for $85,000. They give me 85,000. My risk is minimized. What do they get in return? After 40, 45, 2 months, 45 days, 2 months, the customers are going to pay $100,000. That will be theirs. They bought all these from me for 85,000. They will receive 100,000. This is their gain. But this is non-recourse basis. Non-recourse basis means any bad debt risk has to be borne by them. I am saying this is called forfeited. Okay. Third is called letter of credit. Letter of credit is a sort of bank guarantee where I send goods to him and the customer who has to pay me money, he asks his bank to issue me an LC, letter of credit bank guarantee, that when I receive the goods, even if I try to run away, the bank will issue payment on his behalf. So my risk gets minimized due to letter of credit. Okay. A fourth thing is called counter trading. Counter trading is that I send goods and in return, I don't receive cash. I receive goods of the same amount. Okay, this is counter trading. Like, for example, I sent television, gadgets. In return, the party doesn't pay me cash. They give me some other goods like cars. They are a manufacturer of cars or furniture. This is counter trading. This is advantageous because I receive the goods instead of cash. Puts less burden on foreign exchange because I don't have to pay or receive foreign exchange. So foreign exchange risk gets minimized. But it results in some valuation disputes that I sent you gadgets worth 100,000 and you gave me furniture worth 90,000. So valuation issues are there. Another option to manage overseas receivables is export credit insurance. You all know how insurance works, that I send goods to a customer and then apply for an insurance. What does insurance company do? They take premium from me and insure that if the customer will not pay, the insurance company will pay, like car insurance or life insurance. Okay. This is called export insurance. And one more technique is called factoring. We have studied factoring in local domestic receivables as well, that when you sell goods on credit, you appoint a factor who takes over the sales ledger administration. He gives you advance and charges interest on that. He also takes an administrative fee, but the burden of collection is now on factor. So this is how your risk gets minimized. Okay. So these were the few techniques of minimizing foreign exchange risk for foreign receivables. Remember, in working capital management, we have studied factoring, we have studied receivable management, but that relates to domestic receivables who are in the same country. Foreign account receivable provide additional challenge because I'm sending goods abroad in a different legal system. One way is to simply trust the customer, which is called open account, but this may result in a non-payment risk. So you can manage foreign accounts receivable via taking advance payment. Take advance risk minimizes. Forfeiting, invoices are of $100,000. Some invoice discounter purchases them at 80,000. You get 80,000 immediately. The customer will pay 100,000. The difference will be his gain. LC's letter of credit, in which foreign accounts receivables risk are minimized. You send goods and the customer, he asks his bank to issue a bank guarantee or an LC that if the customer doesn't pay, bank will pay. Okay. Counter trading, you sell goods, in return you don't take cash, take goods of equivalent amount, but the valuation issues are there and there. Export insurance, you apply for insurance to an insurance firm that if the customer doesn't pay, the insurance company will pay. And factoring, same as normal factoring. Okay. These are the 6 ways to minimize the foreign exchange risk of foreign receivable. But remember, before moving in any of these direction, credit should only be given to customers who are creditworthy, because no matter whatever techniques you use, if you give goods to non-creditworthy customers, you will always remain in problems. Okay. Thank you.